Hey everyone, how is it going today? In this video, I'm going to be doing the monthly update on my M1 Finance account for the month of October 2020. And after that, I'm going to show you why dollar cost average or drip investing is so powerful and why everyone should be doing it. Now, before I get into it, if you are new to the channel, I like to find short-term and long-term trading and investing opportunities in typically lower-priced stocks. I like to find undervalued, underappreciated stocks with high growth potential and talk about all other things finance-related as well. If that's something that interests you, please consider subscribing to the channel so you don't miss any future trading or investing ideas. And remember, I am not a financial advisor, so please do all of your own research before buying any of these stocks. Okay, everybody. Well, here is the homepage for my M1 Finance account. We are up to $10,950 at the moment. I am doing this video intraday, so this number might bounce around a little bit. But this account is actually almost a full year old. I started it last November, so by the next month's update video, it'll probably be right around a year old. I started this account with an initial deposit of $500, and I've been depositing $100 a week, with the only difference being on days where the S&P 500 is down more than 2%, I've been making an extra deposit. And usually that's about $100. Sometimes it's more. When the market was tanking because of the pandemic, I was sending a little bit more on those weeks, but for the most part, those are the rules that I have been following. And as you can see, as we're getting closer to the current time period, the account is getting a little bit more volatile. That's because those $100 deposits, they're becoming smaller and smaller compared to the account value, since the account value is going up much higher. So as the market gets volatile, this is probably going to get a little bit more jagged. Sorry about that. The account is going to get a little bit more jagged, but for the most part, hopefully it stays in this nice uptrend of this equity curve. As of right now, the money-weighted return is at 46.38%. In the very first video that I did in August, the account value was at about $8,900 and the money-weighted return was at 60%. And then last month, the account value was at around $9,700 and the money-weighted return was at 49%. So the return has been tapering off a little bit because the market has been volatile. I think a lot of people are a little on edge because of the election. They don't know what's going to happen afterwards, so that usually makes people start buying stocks a little bit less. But for the most part, I am very pleased with how the account is going. Let me scroll down here and show you my positions. My biggest position is Tesla, and that is up 520% since I've owned it in this account. My next best position is Square, and that's up 242%. And I also have Disney, I have CRISPR Therapeutics, and then I have some real estate investment trusts. And these are actually the ones that I am the most excited about right now. I mean, of course, I love this return that I've had in Tesla right now, but the real estate investment trusts have really been getting beaten down, and I've been starting to accumulate more and more of these. And in my opinion, real estate is going to be a lot higher in probably 3 to 5 years. So the fact that they're getting beaten down now because of the pandemic, I am very happy that I'm able to accumulate these at lower prices, because these are going to be paying me pretty good dividends going forward. And actually, if I go up to my account activity here, okay, well, there we go. As we can see, I have gotten a dividend of $2.22 from LTC Properties, and I also got $7.45 from Simon Property Group. I believe that's the biggest dividend I've got so far. But if we go back to the portfolio and go down to Simon Property Group, you can see that I only have $422 in there. So that is a pretty nice dividend compared to the value that I have in it. I have several $1,000s sitting in a savings account, just like an emergency fund in my bank, and I wouldn't even get $7 in interest for the whole year, and I probably have 8 to 10 times the amount of money in that savings account. So it just shows you how nice these real estate investment trusts are paying right now. And if we get through the other side of this, which I'm not that worried that we won't, I don't think that these are going to go out of business. I think that this is going to create opportunities. I know real estate um, is going through a down period right now as far as these rentals go. I mean, real estate in general is still doing well, but some of these tenants are having a hard time paying some of their mortgages and rents, and that's hurting these companies right now. But I think in a couple of years, certainly that's going to be all sorted out, and these real estate investment trusts are going to be a lot higher, and I'm going to be accumulating as much as I can at these lower prices. So in a few years, I should be getting some nice, hefty dividends from these. Plus, I should be experiencing the capital appreciation once these companies get out of the woods. But another company that is paying some great dividends right now is AT&T. I think AT&T has a very bright future. Their HBO Max is should be growing well into the future, and plus they're going to have that 5G growth ahead of them. So I am happy to be accumulating AT&T. I think their dividend is safe. I know there's been a lot of talk that AT&T's dividend is at risk, and there is a little bit of a risk, but I think they are still um, making plenty of cash, and they have plenty of cash on hand. I don't foresee them cutting that dividend. Another company that should benefit from the 5G, of course, is Verizon, and Verizon pays a nice dividend as well. I believe they're right around 4% right now, while AT&T's I believe it's over 7% right now. So two very nice dividend-paying stocks right there. Going back down the account a little bit, we can see I have Apple, I have Skyworks Solutions, Illumina, I have Uber, I have Carnival Cruise Line. This is my turnaround play, and you can see this ship is taking a long time to turn around. I am still down about 40%. I don't think they're going to go bankrupt, so I am happy to be accumulating shares of Carnival Cruise Line as it is in the low teens right now. Other dividend stocks that I have is Dominion Energy. JP Morgan pays a dividend. 3M, of course, pays a dividend. Microsoft pays a small one, but that should be a good dividend payer in the years to come. They should have plenty of dividend growth ahead of them. One of the better performing stocks that I have in the portfolio is Snapchat. Unfortunately, I only decided to put 2% in when I started the account because they were a little bit more of a speculative play, but they have been growing very nicely during this pandemic, and I'm up 409% on that position, so I should have put more into that one. Another stock that I have that I am excited about is Grow Generation. They are in the MJ space, and what they do is supply those companies with the supplies that they need to run their business. You know, one of the theories that I have is sometimes it's better when there's a gold rush to invest in the company that's supplying everybody looking for the gold with the picks and shovels, not necessarily trying to find out which company is going to be the one that finds all the gold. And that's what Grow Generation does. They supply everybody who is in the MJ space with the supplies that they need to grow the stuff that they need to grow. My goodness, get out of here. Rounding out the portfolio, we have Baidu, my exposure into China, and Alibaba. I have a little bit of exposure into China. I probably need a little bit more, maybe with some of those EV companies that they have in China, like NIO. I also have Waste Management, which is another dividend-paying stock. I have Goldman Sachs. That is part of my exposure to the finance with JP Morgan Chase. I have a small position in the bond fund. I'll probably start to raise that when bonds become more attractive, but I only have 1% at the moment. And I have the Vanguard Total, the VNDX ETF. I have the High Yield Vanguard ETF in there as well, and I have some treasuries rounding out the portfolio. But as you can see, I am very well diversified. A lot of people like to have just growth. Some people like to just have dividend-paying companies, and there's nothing wrong with either one of those strategies. I like to have a nice, decent blend. So I have some good growth in the future. I have I have high expectations for Tesla and Square in general, and CRISPR. I think these three companies should have a ton of growth ahead of them. and I'm also very happy to be accumulating these dividend payers as they are at lower prices. But I am very comfortable with this portfolio going forward. Okay, enough of the portfolio for a minute, but I'm going to show you right now why dollar cost averaging is so powerful and why everyone should be doing it. And I found a couple of really good articles on the internet where they make some really good points. I'm going to link these articles in the description because I'm just going to read a little bit of the articles and touch base on a few of the really good points. But they are definitely worth opening up and reading the entire articles because there is some really powerful information. But I'll get right into this first article, and it is called Even God Couldn't Beat Dollar Cost Averaging. And this article says, this is the last article you ever need to read on market timing. And he says, imagine you are dropped somewhere in history between 1920 and 1979, and you have to invest in the U.S. stock market for the next 40 years. And you have only two investment strategies to choose from. Dollar cost averaging, where you invest $100 every month for all of the 40 years, or buy the dip, where you save $100 each month and only buy when the market is in a dip. And he defines a dip as any time when the market is not at an all-time high. But he says, I'm going to make this second strategy even better. Not only will you buy the dip, but I'm going to make you God when you buy. You will know exactly when the market is at an absolute bottom between any two of the all-time highs. And this will ensure that when you buy the dip, it is always at the lowest possible price. Now, the only rule in this game is that you cannot move in and out of stocks. Once you make the purchase, you have to hold the stocks until the end of the time period. He says, so which strategy would you choose? Now, logically, it seems like buy the dip can't lose. If you know when you're at the bottom, you can always buy at the cheapest price relative to all-time highs in that period. However, if you actually run the strategy, you will see that buy the dip underperforms dollar cost averaging over 70% of the time. So he says this is true despite the fact that you know exactly when the market will hit the bottom. Even God couldn't beat dollar cost averaging. And he says, why is this true? Because buying the dip only works when you know that a severe decline is coming and you can time it perfectly. Since the dips, especially big ones, haven't happened very often in U.S. market history, this strategy rarely beats dollar cost averaging. And the times where it does beat dollar cost averaging require impeccable timing. Missing the bottom by just 2 months lowers the chance of outperforming dollar cost averaging from 30% all the way down to 3%. And he goes into some graphs displaying what he is talking about. Right here, this first one, it shows you with these green dots. These are all-time highs, but the dollar cost average strategy is buying the whole time. And the other strategy cannot buy until it hits an absolute bottom. So if we scroll down to the next graph, the all-time high and the dips for the S&P 500, this is when buy the dip buys. Buys these lows, but from the year 2000 all the way to the absolute bottom in 2009, it is saving $100 each month and it is not buying. So it's accumulating a huge pile of cash, and then it makes that buy at the absolute bottom in 2009 and follows the market all the way up. And this is the next time that it's buying. So it's accumulating cash every one of these months, and then it's buying here. But you got to remember, every time it's accumulating cash, especially on the way up and not buying the dips, you're making no money on that cash. It's just sitting in cash. So when we scroll down a little further, it shows you on the buy the dip strategy how much cash you're actually accumulating. So we can see from 2000 all the way to the market bottom in 2009, the cash was building up. And this was a huge purchase at the bottom of 09, but because in 09 when the market took off, this gain from 09 was enormous because that buy down at the bottom was so concentrated. And if we scroll all the way down to the last graph, you would think with a concentrated buy this big at the absolute bottom, that the outperformance would have been immense. But if we go back down to the graph, we can see that during this time period from 1990, it barely outperformed dollar cost averaging. So I thought that was quite interesting. All right, guys, well, this is the second article I wanted to show you, but just going back to that first article for just a second, just remember that slight outperformance in the buy the dip strategy was only if you accumulated all that money and you bought at the exact bottom. They had that huge concentrated buy at that exact bottom in 2009, which is virtually impossible to do, but I just wanted to emphasize that one more time. But anyway, this next article is on the irrelevant investor, and he basically is comparing these same two strategies. He goes into them a few different ways just to show you how that they end up coming out. And the very first one that he goes over with the dollar cost average strategy versus the buy the dip, it says the dollar cost average strategy contributes $1.03 every trading day, while the buy the dip strategy contributes $1 every day, but an additional $1 when the S&P drops 2% or more. Now, both strategies contribute $7,858 in the total time. So the 30-year period, they're both contributing the same amount of money, but the $1 where the second strategy, the buy the dip, is doubling down on the big down days, it's spread out evenly with the dollar cost average strategy. And the dollar cost average strategy still outperforms the buy the dip strategy. And if we go down to the second strategy, it says the dollar cost average strategy contributes $4.42 every trading day, while the buy the dip strategy contributes $1 every trading day, but an additional $100, so 100 times the amount on the days where the S&P 500 drops more than 2%. Now, in this article, it's the same. Both strategies contribute the same amount of money, $33,598 over the 30 years, but in the dollar cost average strategy, it just spreads it out evenly. And the dollar cost average strategy in this scenario, which you would think that maybe the buy the dip would outperform because when it buys on the low days on the big down days, it's super concentrated, but the dollar cost average strategy still outperforms, and it actually outperforms by a greater margin. So taking the guesswork out in this strategy and just spreading it out every single day still has an outperformance over the strategy that concentrates when the market is pulling back. Now, this last one is going to be the one that I implement, and this is basically the only one. This is basically the only one where the dollar cost average strategy is beaten by the dip strategy, except for that very first article where you had that huge concentrated buy at the absolute bottom. So this is the one that I do pretty much. But this one says the dollar cost average strategy contributes $1 every trading day, while the buy the dip strategy contributes $1 every trading day, but an additional $1 every trading day where the S&P 500 drops more than 2%. So the buy the dip strategy actually contributes an additional $260 over the time, over the 30 years shown on this graph, but it actually outperforms by over $1,000. So over 4 times the amount it made just by adding an extra dollar on the 260 trading days where the S&P 500 dropped more than 2%. So this is basically in a nutshell what I do. I contribute the same amount every week, but when the S&P 500 dips more than 2%, that's when I make an additional buy. And that is the only difference that I do. But as you can see, it's one of the few times that it actually outperforms just doing dollar cost averaging. All right, folks, well, there you have it. That's the update for my M1 Finance account for October 2020. If you have any questions, please don't hesitate to leave them in the comments below. I'll be happy to answer any that I can. Please like this video if you enjoyed it, and subscribe to the channel if you haven't already. Thank you so much for watching my video, and until next time, take care, everybody.